Mortgage update for buyers and home sellers. The Bank of Canada just cut its policy rate by 25 basis points to 2.5%. Unemployment is up and inflation momentum has cooled, so they're easing rates while staying cautious. Variable rates. These mortgages track each lender's prime rate, which typically moves with the Bank of Canada overnight rate. So this cut will lower variable borrowing costs once banks adjust prime. For fixed rate mortgages, they mostly follow the Government of Canada bond yields, especially in the 3 and 5 year terms. The yields have been hovering in the high twos, low threes lately, which supports modestly lower fixed rates if that level holds. Choose variable if you can tolerate mortgage payment changes and want to benefit if those likely cuts continue. Now choose fixed if you value certainty over chasing possible extra savings. And hybrid mortgages, which is split between both, another cut by even the next decision date, October 29th. But as with all of them, it's data dependent. Recent coverage pegs odds near even, and several desks flag a year-end policy rate around 2.25% if growth remains weak and inflation behaves. Of course, I can't confirm the exact path. No one can, but the bias is toward gradual easing. Now, a big question is, will this rate cut stimulate Ontario real estate? Well, the short answer is yes, but a modest yes. National sales momentum was already improving into August. The Canadian Real Estate Association noted activity could pick up further if a September rate cut drew buyers off the sidelines. GTA affordability is still tight. Toronto Real Estate Board says further rate relief would help, but constraints remain. Big picture forecasts from RBC and Desjardins call for gradual recovery as rates ease and inventory stays ample, again pointing to a slow thaw rather than a spring melt. The bottom line for buyers today, the cuts will improve the math a bit, especially on variable rate mortgages. There's fixed quotes. Get a fresh pre-approval. Compare fixed, variable, and hybrid options side by side. But pricing still needs to reflect local supply and affordability realities, especially here in the Hamilton, Burlington, and Niagara areas.